All right, today we're going to break down one of the most powerful financial strategies out there, one that's used to legally minimize and sometimes even eliminate taxes. It's a three-part engine that can totally flip your understanding of wealth, income, and what you owe the government. Let's dive in. So here's the central question, and it sounds kind of backwards, right? For most of us, the math is pretty straightforward. You earn more money, you pay more in taxes. But for those who really understand the inner workings of the tax code, generating more wealth can actually open up ways to lower their tax bill. It seems like a paradox, but it all hinges on one single critical distinction. Okay, so this slide right here, this is the foundation for the entire strategy. You see, the tax code treats two kinds of financial gains in completely different ways. Over on the left, you've got earned income, the money you get from your job or your business. That gets taxed every year like clockwork. But on the right, you have asset appreciation. That's the increasing value of stuff you own, like stocks or real estate. And here's the kicker. That growth, that wealth, isn't taxed at all until you sell. That single difference is what turns the key in this whole engine. So let's look at the first piece of this machine, what we're calling the value engine. The fuel for this entire strategy is simply acquiring assets that appreciate. Things you expect to go up in value over time. We're talking real estate, stocks, private equity, you name it. Now, the power here comes from a concept called unrealized capital gains. It's a fancy term for a simple idea. It's the profit you've made, but only on paper. Because you haven't actually sold the asset, you haven't realized the gain. And because of that, the tax code says, hey, that's not income. This is huge because it lets you build up enormous amounts of wealth without getting a tax bill every single year. And this chart just shows you exactly what that looks like in practice. As you can see, an asset could easily double in value in just a few years. That's $100,000 of new wealth created. And the tax you owe during that entire time? A big fat zero. The engine is humming along, building value, completely tax-free. But, that brings up a really obvious question. How in the world do you actually spend any of this money if selling it triggers a massive tax bill? And that brings us to the second part of our engine, the liquidity faucet. This is the clever mechanism that turns all that on-paper wealth into cold, hard, spendable cash. And you guessed it, without triggering a tax event. So if you want to get your hands on the cash value that's locked up inside your asset, you basically have two choices. Option one is the one everybody knows, you sell. But the moment you do that, boom, you trigger capital gains taxes on all your profit. Plus, the asset is gone, so it can't grow for you anymore. Option two, though, is to borrow against the asset. You use it as collateral for a loan. And this is the absolute core of this strategy. This table just lays out the difference, and it is stark. Look, in both cases, you walk away with $700,000 in cash. But look at the consequences. Selling means a huge tax bill, and you shrunk your asset base down to just $300,000. Borrowing, you owe zero in tax, and you still own the entire $1 million asset, which is still growing for you in the background. The difference in your future net worth is just massive. So why does this even work? Well, it comes down to two very simple reasons. First, and this is the most important part, the government does not see the money you get from a loan as income. It's not a gain, it's debt. So it's not taxable. It's that simple. You get access to all that cash, and it never even shows up on your tax return as income. And second, because you never actually sold the asset, you still own it. It's just sitting there backing up your loan. This means your asset can keep growing in value, piling on more and more unrealized gains, even while you're out there spending the money you borrowed against it. And listen, this isn't some secret back alley technique. There are plenty of well-established financial products designed to do exactly this. For your stock portfolio, you have things like a securities-backed line of credit or SB lock. For real estate, a home equity line of credit, a HELOC, is super common. Business owners can do the same thing. These are standard, everyday tools used to pull off this incredibly effective strategy. All right, now for the grand finale, the last and maybe the most powerful piece of this whole engine. This is the part that deals with what happens to all that accumulated untaxed gain in the end and how the tax slate gets wiped completely clean for the next generation. This whole magic trick is accomplished through a tax rule called the step-up in basis. Okay, so basis is just what you originally paid for an asset. When you pass away and leave that asset to an heir, the tax code actually lets the cost basis step up to whatever the asset is worth on the day you die. Here's exactly how that works. Let's say you bought a property for $500,000 way back when. Decades later, when you pass on, it's now worth $2 million. Your heir inherits it, not at your original cost, but at the new stepped-up basis of $2 million. So that entire $1.5 million in growth, that huge unrealized gain you held your entire life, is never ever taxed. If your heir turns around and sells the property the very next day for $2 million, their taxable gain is zero. The tax liability just vanishes. It's legally eliminated. So when you put all three parts of this together, you buy assets, you borrow against them, and then eventually you pass them on, you have a complete system. It's a system for building wealth tax-free, accessing that wealth tax-free, and then passing it on, you guessed it, tax-free. And it really requires a totally different way of thinking about your finances. Ultimately, this whole thing isn't just a series of moves, it's a complete mindset shift. It's all about moving your focus away from what you earn, which gets taxed heavily and immediately, and putting all your focus on what you own, where the rules of the tax game are fundamentally different and, well, much more in your favor. And this really leaves us with one final big question to think about. Is this system some kind of accidental loophole that needs to be closed? Or is this just how the tax code was intentionally designed from the very beginning, to treat capital and labor in fundamentally different ways? The answer to that question has some massive implications for how wealth is built, and it's definitely something worth thinking about.